This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
All right, as I explained in the last lecture, I'm going through section A of the September 2016 F9 exam, but we'll do 5 at a time. So I did the first 5 in the last lecture. In this one, we'll do questions 6 to 10. We'll do the next 5. So off we go again. Number 6. In relation to an irredeemable security paying a fixed rate of interest, which of the following statements is correct? And they all say as risk rises. The first two say the market value of the security will fall, either to ensure they receive an increased yield or a reduced yield. The second two, as risk rises, this says the market value of the security will rise to ensure either an increased yield or a reduced yield. Well, it may take a minute or two to read through the English and check, but otherwise this really should be very, very easy. If you've been watching the lectures, you'll know that the market value of the security will be the present value of the future receipts, the future interest. In this case, it's irredeemable, discounted at the investor's required rate of return, i.e. the yield. And what happens as risk rises? The more risky something is, the higher the return investors want. So more risk leads to a higher yield. They'll want a higher return the more the risk is. So we immediately know the answer is what? A or C. But what happens if they want a higher yield? If you're discounting at a higher rate, the market value will fall. And I say again, if you're at all unsure about what I've just said, you must go back and watch the lectures on the valuation of securities, where I actually make that point and explain why. So what's the answer? As risk rises, the value of the security will fall so that investors are getting a higher yield. So the answer is A. What about 7? Which of the following statements about the change in pop company's working capital financing policy is true? And what is the policy? They're switching from using mainly long-term fixed-rate finance to fund the working capital to using mainly short-term variable rate finance. And again, this is something I discussed in, I think, the first of the lectures on working capital, that the different policies as to how to finance working capital, either a conservative policy using long-term finance, which is what they're doing at the moment, or a more aggressive policy using short-term finance. And so, let's have a read through them. Which of the following statements are true? They're switching from long-term to short-term. Finance costs will increase. Well, no, they may increase. Short-term borrowing might have a higher interest rate, but remember, with short-term borrowing, you're only day by day borrowing the amount you need. Whereas with long-term fixed borrowing, there'll be plenty of times you're borrowing more than you need. So you cannot say finance costs will increase. Finance costs are the interest. B, financing risk will increase. Well, yes, that's the whole thing about using short-term finance. Why it's aggressive, it's more risky because long-term fixed-rate finance, is not repayable until a future long-term date. You've plenty of time to arrange replacement finance for when it comes to be repaid, whereas short-term overdraft finance, the bank can demand it back up instantly, so it's much more risky. And the answer is B. I'll carry on with the other two, but the answer is B. Interest rate risk will decrease. No, I mean, that's the opposite of what I've just said. Overcapitalisation risk will decrease. No, I mean, it's not directly related to overcapitalisation, but one symptom of being overcapitalised is you've too much long-term capital. But it's not directly related to what we're talking about here. So the answer is indeed B. Let's move on to 8. In relation to an operating lease, which of the following statements is correct? Again, another very quick one. Sorry repeating what I know I said in the first lecture, but it's these short ones here where you've not a lot to read and you've no arithmetic to do, where pretty quickly you should be able to sort out that either you know the answer and you get it right, or you've never heard of an operating lease. Well, you'd guess. Staring at it won't make it any easier. But an operating lease, effectively renting the asset. All the risks and rewards of ownership transfer to the lessee. The lessee is the person doing the renting. No. It still belongs to the lessor, the person you're renting it from. B. The asset and lease obligation were recorded in the statement of financial position. No. That's talking about a finance lease where we might do that, but an operating lease, no. It doesn't appear in the balance sheet, the statement of financial position. The rent, the lease payments, are just an expense in the profit statement. C. The lease period will cover almost all of the leased assets' useful economic life. No. An operating lease, you rent it for as long as you want it. You know, you might just rent for 2 years, even though the asset's is capable of lasting 10 years. So no. But finally, D. The lessor, the person you're renting it from, will be responsible for repairs and maintenance of the asset. Yes. Finance lease, no, we'll be responsible, but an operating lease, we pay the rent. It's up to the person we're renting from to sort out repairs and maintenance. So the answer is D. Number 9. Here's a calculation one. It doesn't look too long, but you know, I would still jump and do those very short ones first. What is the theoretical value of the company? And what have they told us? A company has annual after-tax flows of 2 million a year, which are expected to continue in perpetuity. The cost of equity is 10%. The before-tax cost of debt is 5%. The after-tax weighted average cost of capital is 8% per year, and tax is 20%. What's the theoretical value of the company? The whole company. It's not saying value of the equity, it's just saying the whole company. Well, the value of the whole company, you'll know again from the lectures, there are several ways you might value it. You know, question number 1 was net assets, if I remember rightly, in this section A. But here, the information given, to get the value of the company, we take the after-tax cash flows, which we've got. Had they been pre-tax, you'd have had to subtract tax at 20%. You discount at the weighted average cost of capital. Which automatically is after tax, weighted average cost of capital. We always calculate after tax. And the after tax weighted average is 8%. And so how do we discount a perpetuity? For a perpetuity, it's 1 over R, or here 1 over 0.08. 2 million divided by 0.08, 25 million. So apart from the time it takes to actually read it and being careful, you know, there's 3 different percents there, 4%, 10%, 5, 8 and 20. So apart from reading, being careful to pick the right one, that's a very easy one. 10. Which of the following would you expect to be the responsibility of financial management? I think this really should be the easiest question on the whole paper. Producing annual accounts? No, that's the financial accountant. Producing monthly management accounts? No, that's the management accountant. Deciding pay rates for staff? Good heavens, no. That's the management accountant's job. C. Advising on investment in non-current assets? Yes, surely that's one of the core areas of the financial manager. Investment appraisal and all the discounted cash flow that goes with it. So the answer there is C. I can't believe anybody would get that one wrong. Anyway, I said 5 at a time, so now we're up to number 10. I'll stop this lecture here, and in the last one, we'll go through the remaining 5.